Hey guys, this month's meeting is sponsored by me, Maura McGraw. I am a real estate agent here in the great state of Alabama, and I specialize in helping investors grow and scale their investment portfolios. So whether you are flipping, expanding your rental portfolio, or even diving into multifamily, I would love to help you expand your portfolio. Real estate and investing is truly my passion, so if that's something that interests you, make sure that you give me a call or send me an email. I'll put my information in the description below. Everyone, we're gonna get started. Okay, I'm Maura, if I haven't met all of you. Thank you all so much for coming to, this is our second meeting. We do them every month, usually the last Friday of the month. As you know, today we're talking all things tax strategy with our all-star tax panel that we'll introduce here in a second. But we're gonna start off our meeting with a quick around the world introduction. Everyone will stand up, say your name, what you do in real estate, one give and one ask. So I'll go first so that you have an example. My name is Maura McGraw. I am a real estate investor and agent here in Mobile County, Baldwin County, and up in Birmingham. My one give, I've been using this platform called Monday.com. Does anybody use that? I've been using it for about 5 years. I use it to manage my whole real estate business. It is awesome. So if you are looking for a project management and CRM all-in-one that's very cheap, Monday.com is a great one to check out. My one ask is I am looking for an executive assistant right now. So if you happen to know someone that wants to learn the real estate business, I am currently looking for someone. Rob, do you want to go next?
Hi, good morning, good afternoon. My name is Rob Schell. I'm with Compliant Cash Flow. We're a rep, just cost segregation company in America. I've been in this business for 10 years. I'm friends with Maura and business associates with Maura. I've done projects for her family, both for Maura and with her dad on the West Coast. And she brought me here to kind of talk a little bit about cost segregation and how I might be able to help educate the community a little bit. Just to give you an idea, I think this meeting started last month, and my partner, Lauren Burgess, who was here last month, met a couple of people here and already has multiple deals in play, and she's closed 2 deals in the last 30 days through one of the bankers that came to this meeting. So this is working from a community perspective, and I want to thank Maura for putting this all together.
And thank you to Rob, who provided lunch for all of us, as courtesy of Rob.
Well, I did not provide lunch, but my name is Jeffrey Kintz. I'm a real estate CPA with Wilkins Miller in Mobile. So Wilkins Miller is the largest accounting firm that's headquartered in Mobile. So we serve Mobile and Baldwin counties. We have a large construction and real estate presence. We work with clients that really develop, own, and manage mainly commercial real estate in the area, but we also handle some residential as well. And really kind of our mantra is, we work with complicated businesses and structures and things like that. So the more complex, the better for us. But I'm really excited to share. I've got some tips here and some pitfalls to really help y'all on the tax side for wherever you are. So my give is that I'm going to give you some tips here. And my ask is that you ask questions and really engage with us to make this more beneficial for everybody. So thank y'all.
I'm Gil Dukes. I'm a tax lawyer in Mobile, just a boutique firm, 4 tax lawyers, and my stepdaughter is there as well. Formed a little company back in 1994 called Alabama 1031 Property Exchange. It handles a lot of tax-deferred exchanges all over America, primarily in the Southeast. I'll be talking a little bit about tax-deferred exchanges, and I'm open to questions as well.
Hello, I'm Maria Oliver. I'm with Real Broker. I am a realtor. I've only been a realtor less than a year, so at this point, I'm just a sponge trying to soak up all the information I can get. I am interested in starting to invest too, so which is why I became part of this group, and I'm here. So that's about it.
Hi, I'm Amanda Eckert. I'm also an investor and a real estate agent at Real Broker. And my give this week is just a reminder, because I think sometimes there's so much new information that when we hear the same thing over and over again, it can be just as valuable. And with the information that we're going to hear today, something I heard at one of the groups I went to last week or 2 weeks ago was just the importance of not losing money. Sometimes we get so focused in making money that we forget and we start letting things like slip through the cracks in little bits and little bits and little bits. So my give is just a reminder that I got that I want to pass along and remind all of us over and over again. And then my ask would be just to keep an eye out for any great investment opportunities, and let's keep spreading the knowledge.
Hi, my name is Philip Allen. I'm a short-term rental manager for Reef Properties. And my one give that's been on my plate lately is that trying to focus on one thing, not be distracted with so many different, let's say, lead generation or whatever it might be, just business practice or different things. Focus on one thing and get good at that before you move on to like 10 different ones, because that's what I like to do, is try to focus on way too much. My one ask is, if you have a short-term rental, at least give us a chance, give us a call, see what I can do to help you. We're here to help, so even if you don't use us, I'd be happy to inform you with any knowledge that I have.
I'm Joe Pearson. I'm also with Reef Properties. My one give is nose to nose, toes to toes. When I first started in real estate, that was one of my good friends told me, and basically it means get in front of people. Get in front of people, talk to people, and this goes for real estate agents, investors, everybody. It's all about relationships. It's all about building those relationships, and that's why this is such a good meeting. My one ask is, if you are looking for short-term rentals, to add that to your portfolio or have clients that are doing that, reach out to us. We can give you projections. We can give you advice. We're happy to talk to them. And like Philip said, even if we don't have your business, we're coming at it from a place of giving. We want to help.
Hey, my name is Donnie McGriff. I've lived here in Fairhope for about a year now. I've been going direct to seller, so just doing off-market single-family stuff for about 5 years now, full-time. And my give is, for one, I do have any realtors, if you got like a homeowner that's looking to buy in Foley on 2 acres, talk to me about it afterwards if you have that. Another give would be, I have more time. I'm trying to phase myself out of the single-family stuff. And so if you're into commercial and you need somebody to do some grunt work or whatever, there's something maybe I could bring value to you because you don't have the time to do something and you need somebody. I have time and energy to do more commercial stuff than single family. I guess the ask would be kind of the same thing I was just talking about. I really like the idea of self-storage, so if that's something you're really into, I've been trying to get my training wheels off of that for a while now. But yeah, that's it.
Eric Oden. My focus is commercial real estate, particularly retail, shopping centers, and multifamily apartments. My give is, I started as a house flipper. If anybody needs like a checklist, once they get their property under contract and would like a copy of it to kind of know what it flows to closing day, I'd be glad to provide that. So my only ask then is just link up with me. Let's get a business card, and I'll give you contact information.
How's it going, everybody? My name is Dave Brown. My specialties are extended stay motels, medium-size multifamily apartment complexes, and I guess my one give would be to utilize technology to create systems and processes to make your business as efficiently as possible. I own and operate almost 300 units with like 6 people, so that's my giving.
My name is Matt Haddon. I'm a real estate investor. I mainly focus on medium-sized multifamily, buy and hold. I have done fix and flips and wholesaling also. My one give would be Cash Flow Quadrant by Kiyosaki. Is a great book if anybody's never read it. And my only ask is that just reach out to me and let's make a connection. So.
Sterling Stoutenmeyer, moved here about 3 years ago to retire, failed at that. And I do have some real estate investments. My background's in finance and technology, though. Did a lot of turnaround work for private equity firms for the last, 15, 20 years. And these days, I would say that my give from the last time I was here is the Calculated Risk newsletter. I found it to be pretty good. It's got a lot of good research in it about just macro trends in the market and what's going on and kind of where things are headed, so you can do some planning. And my ask is, I'm kind of curious what services are needed around home services or builder services, just because I'm looking at some opportunities and being the pickaxe and shovel vendor to the industry in that regard.
The newsletter?
It's called Calculated Risk.
My name's Jeff Jacobs. I have nothing to give you. I'm kidding. I'm the Director of Development for Wilkins Miller. This is Caitlin Thickpin. She's a CPA here in our Fairhope office right here on Section Street. And so we're here to support our man, Jeffrey. And that's it.
There's a cheering section?
Yes, that's it.
You want it?
No. Sorry.
One more person.
Yeah. There you go.
Sure. Hi, my name's Jonathan Howell. I'm a meteorologist by trade, so that's my full-time job right now. But I'm new into learning as much as I can about real estate investing because I'm interested in a second career and maybe early retirement from my current job. I guess my give would be that if you're a new real estate investor, I think a great book, something I've been reading and enjoying is one by, it's called The Small and Mighty Real Estate Investor by Carson is his last name. I forgot the first name, so I'll get you that in a minute. My ask is, I'm trying to learn as much as I can about how to really get into this world of real estate investing. My interests are with buy and hold in a fairly good quality neighborhood that I can hold on to and make some value with equity in the long run. And also just here to meet as many people as I can and learn from you. So if you've got tips from when you started in this business, love to talk to you and kind of learn about some of the deals you did in the early part of your career. So thank you again.
Good morning. Yep, still morning. My name is Eddie Medina. I am the services manager for Floor and Decor. We're a hard surface flooring supplier, commercial as well as single family homes. We're out in Mobile. Give some real estate. I do have a house in Atlanta, so I'm sort of getting my feet wet with the flipping and all that. It's pretty new to me, but it's pretty fun too. Let me see. Give. Not sure, but if anybody has a need for flooring or anything like that for projects or apartments or whatever the case may be, just get with me. We can take care of you and then ask. If you need anything, just ask, I guess.
Hey guys, Matthew Lopum. I'm a mortgage lender here in Daphne, primarily focused on like single family and duplexes, but we've also started to get our feet wet in the commercial game a little bit. My give and ask are very similar. Just I'm always looking for new people to talk to as far as helping them buy a house or helping one of their clients buy a house, whether it's primary, investment, whatever the case may be. I also want to talk to anyone about all our different loan types if you have any questions about what you can do on the financing side. So just give me a call.
Hello, my name is Rich Cicerelli. I'm a real estate investor and developer and also getting into private equity. And in real estate side, I'm going to start investing in self-storage units. So also the give, invest in real estate, you can't go wrong. It's it's a long-term goal and it's pretty lucrative. The ask, I don't really have one.
I am the property manager at Water's Edge PMG. We specialize in medium and long-term rentals. My give. What's something that is working for me in my business? My calendar. So my give is I guess the older I get, the more I think that I can remember things, but I cannot. And I say that I'm gonna use my calendar, and once I start using it, it's helpful for me. So I recommend to everyone to please utilize your calendar and your notifications on your phone. My ask is that if you have a medium or short-term property, that you would consider letting me manage your property for you.
I'm Hannah Bickford. I'm a newer agent here in Fairhope at Water's Edge Realty. So I'm just looking to soak up any information that I can. My give would just be to get on social media. It's hard, but it works. Yeah.
Hi, my name is Marcus Walker. I am lifetime resident of Fairhope here, born and raised. I'm a realtor and looking to get back into investing. I pulled out of everything because I got scared and ready to get back in. Probably not the best timing, but what can you do? Give is back to basics. It's probably super elementary, but Canva, if you're not familiar with it, it's a great tool. It's free. It makes you and your brand or create a brand if you haven't done that yet. Or anyway, look into it. It's a great tool. And then my ask is for creative financing options. Cool.
Cool. I am Stacy McElroy. I was here last month. It was fantastic. I'm a law enforcement officer, work for Gulf Shores Police Department. I'm in 26th year in my law enforcement career, and I'm tired. So I'm looking at real estate to kind of exit out of law enforcement. My wife and I, we own a beach rental on West Beach in Gulf Shores. It's a condo at Sunchase Condominiums. We've been self-managing that for about 4 years now. I've done pretty well. One thing I found out with one is to kind of consolidate. We use Logify as our PMS, and then we also use another one for pricing is Price Labs. When I switched, I was a little bit skeptical at first when I switched over to Price Labs because the prices they wanted during the summer were something we would never ask for, and I couldn't believe that people were paying those rates. When I bumped it from like $250 a night to $400 a night, and people started paying it, I'm like, holy cow, I couldn't believe it. Then, of course, all my partners in the same complex started looking at my rates, and they all jumped their rates up, obviously, as well. So I guess that's my give, I guess. Like this gentleman said, use technology for your businesses. And that's another thing I like to learn about, AI. I have no idea anything about that. And my ask is if anybody needs any help with anything, I don't want to get paid. I just want to learn. So if you need help with whatever, picking up lumber, whatever, I'm just here to learn from everybody who has a lot more experience. My interests are obviously short-term rentals, and also I'm looking at storage units as well.
Thank you. Hey guys, my name is Eddie Summerlin. I'm a co-owner of Revitalize Home Buyers. We focus on direct to seller. So we look for properties, and I also flip properties, and we wholesale occasionally. My one give would be to never give up. You never know when you're going to have a bad day. You never know, the phone's not ringing. You might have a good day where the phone is ringing, and then you never know that, if that's going to be the reason for your bad day later, So just don't give up. Keep doing it. My one ask would be, I'm currently in the process of selling all of my rental properties, and I need to go back to the drawing board on what I really want to accomplish with that. And I have some ideas, but if anybody owns rental properties, and maybe I can pick your brain on some things about that. Thanks.
Hi, I'm Caroline Cho with Revitalize Realty. We are serving the Gulf Coast of Gulf Coast, Alabama, and Mississippi for property management in single-family residential homes. My give is if you do a lot of virtual meetings with people, Read.ai is a very great AI tool that takes meeting notes for you, and will record your meeting, spit out like a summary and all of that. So if you have to refer back to it later, oh yeah, what did this property owner say about this their property or whatever it is. Like, it's very handy, and it works really great for like when you have a Zoom meeting with like 10 people as well. Not for this case because we're all in person. But that's my give. And my ask is, if you have a lot of connections with like realtors or financial advisors, people that would have clients to refer to property management, please make an introduction for me, because I am terrible at like saying hello for the first time, but I do love nurturing relationships. So thank you.
I think we have one person. You want to introduce yourself?
My name is Shelby. I am an investor in the area. I invest in long-term and short-term rentals. I'm definitely still new to the investing world. I started June of last year, so I currently own one long-term rental and I'm under contract for a short-term rental now. So I'm just looking to meet other fellow investors and also partnerships, and just learn as much as I can from everybody. So.
What a reverse 1031 exchange is and how the process works, in case some people have never done it before.
Thank you. A 1031 exchange is when someone exchanges one piece of property that's been held for investment for another. If it's properly structured, you can defer the gain. Let's first talk about what's a candidate for a 1031 exchange and what is not. If someone calls me up and says, hey, I own a home on Ono Island and I'm selling it and I want to do an exchange, I mean, the first thing that pops in my mind is, well, is it investment property, as that term is used under Section 1031, or is it more in the nature of a second home used for personal use? Second homes used for personal use are not candidates for tax-deferred exchanges. So we're talking about property that's been held for investment. On one end of the spectrum is a rental house. On the other is a home on Ono Island that's never going to be rented. Okay, I mean, you can exclude a little bit of gain when you sell your primary residence. You can do a tax-deferred exchange on a rental house. There's nothing saying you don't have to recognize gain on an Ono house. It's just a second home, okay? The word flip, I've heard a few people say that today. The word flip and 1031 don't need to be in the same sentence, okay? So somebody calls me up and says, hey man, I flip houses, I'm getting ready to sell one. Somebody told me to call you. Well, we're getting ready to have a conversation about, the only thing that's a candidate for 1031 is property that's been held for investment. A perfect candidate would be a house that you've been renting out for a while and now you want to sell it and invest it in something else that you're going to hold for investment. Somebody who buys something, fixes it up, and immediately puts a for sale sign out front, that's property held for resale. That's not really what 1031 is about. So if somebody flips houses, what I like to tell them is, hey, buy it, fix it up, and I know this messes up your attempts to sell it, but try to rent it out for a while, hold it for investment for some period of time, then put a for sale sign out front, sell it, and call me before the closing, and we can structure it as a tax-deferred exchange. LLCs. Sometimes people call me up. We are selling a shopping center, for $5 million, and I want to do a tax-deferred exchange. I'm gonna say, well, what did you mean by we? Well, it's in an LLC. Okay, well, now I'm talking to somebody that doesn't even own the real estate. You got to think in terms of tax ID numbers. I mean, whatever tax ID number has been holding the property for investment, that tax ID number is the one that's a candidate for a tax-deferred exchange. This guy isn't even selling a piece of real estate. And if the LLC sells a shopping center and liquidates and gives everybody the money, you can't do an exchange with a dividend, basically. So, the only remedy for that type of situation is called a drop and swap. You pull the real estate out of the LLC, and then in a perfect world, the human being would hold it for investment for some period of time, and after he's held it, then they'd sell it, and he would just be a tenant in common, and he could do an exchange with his fractional interest in that shopping center, and the other owners could go home with their money or do tax-deferred exchanges as well. Another thing I heard you mention storage buildings. I mean, I see a lot of storage facilities being sold. You got to be careful with the purchase price allocation. Somebody calls me up and says, "Hey, I've got an offer for my storage building, $2.5 million." Okay, and then you start looking at it, and the buyer has allocated some of the $2.5 million to goodwill or going concern value or an intangible called contracts. The only piece of that $2.5 million that's a candidate for an exchange is the amount of the purchase price that's allocated to the real estate. The amount of the $2.5 million that might be allocated to something other than real estate is not a candidate for a tax-deferred exchange. So you got to be careful when you're selling something like that with the purchase price allocation. But a typical tax-deferred exchange is, somebody selling a piece of timberland. a commercial building, a rental house. If you've got multiple rental houses, you got to think in terms of, hey, somebody calls me up, hey, I've got 6 rental houses, I'm going to sell them. I want to do an exchange. I'm going to be thinking, are we going to bunt? Are you going to sell one and another all as part of one exchange? Where the 45 and 180-day period are going to start on the date of the first sale, or are we going to kind of sell one and then maybe you call me up a couple of months later and we're going to do a totally separate exchange that'll have a brand new 45 and a brand new 180-day period. You got to think about things like that because you can sell more than one piece of property as part of one exchange. But the date of the first sale starts the 45 and the 180-day period that I'm getting ready to talk about. So, a lot of times I've got this little company called Alabama 1031, and we do a lot of exchanges, probably in the middle of 100 right now, for example. And a lot of times I don't even talk to the client. I mean, the closing agent, the title company calls us up. Hey, they're sitting right here. They want to do an exchange. Shoot us the documents. I mean, that happens a lot. And so, but we get the title commitment, find out the names of the parties, find out where the property is, punch out the 1031 documents. We shoot them to the closing agent. The closing agent rounds up the client's signature on the 1031 paperwork, side by side with the deed, closing statement, etc. And then pursuant to those documents, instead of giving the money to the seller, the closing agent wires the money to us. Now, what that means is the money gets wired to the trust department of Hancock Whitney Bank. We've got a couple of trust offices over there that handle all the wires in and out of the escrow account. But anyway, the deal closes, the money gets escrowed, and then I'll write them a letter. Okay, we got your money. And I'll start talking about the mechanics from that point forward. Step one is within 45 days after the sale, you've got to pick out one or more different pieces of property that you might want to buy. That's called identifying property. You can put up to 3 different things on the list, or you can put more than 3 things on the list. But if you put more than 3 on the list, then you got to make sure that the total value of everything on the list doesn't exceed twice the value of what you sold. So if you sold something for $200,000, you can put 5 different potential targets on the list as long as the total value is more than $400,000 in that example. You got to do that within 45 days. And the date of the sale also starts a 180-day period in which you've actually got to buy some stuff to successfully complete the exchange. And so, they call us up 2, 3, 4 months later. Okay, Gil, we're getting ready to close on a piece of property. And, hey, who's the closing agent? We call the closing agent, get the title commitment, get their wiring instructions. And as soon as the client's ready for us to wire the money, we'll wire the money to closing agent number 2, and that deal will close. And then I generally, write them a letter, and it's basically a legal opinion saying, hey, you sold something for $300,000, you bought something for $310,000. It looks like it's a tax-deferred exchange to me, assuming a few things. One of the things that I have to kind of CYA on is depreciation recapture that y'all are going to hear a discussion about in a little while. I mean, when people close the sale, escrow the money, sometimes I've never even spoken to them. We do so many of them. I don't know if they've done a cost seg on what they're selling. So I kind of have to tell people, hey, y'all are hiring my company to be an intermediary. I'm gonna draft all the documents for it to be a properly structured exchange. But there's some things that you haven't asked me to give you advice on, like real estate purchase agreements or reviewing the title commitment, or depreciation recapture. I've got to kind of cover my A or whatever on several issues. But the typical exchange is what I just described. They sell, escrow, buy something else within 180 days. That's called a deferred exchange. Sometimes exchanges are simultaneous. Hey, Gil, I'm selling property to somebody and I'm getting my replacement property on the same day, just back-to-back closings. Well, whether it's a simultaneous exchange or a deferred exchange, if somebody is selling property to one guy and buying a piece of replacement property from a different guy, that's not an exchange. To be an exchange, you've got to be conveying your property to the same party from whom you acquire replacement property. That hardly ever happens, right? But, and by the way, back in the 1980s, what I just said caused a bunch of problems. If you sell to one guy and buy from another, that's not an exchange. And so back in the 80s, people if I was selling my property to you, I'd have to get you to become a party to my acquisition of the replacement property. And then, I'd sell my property to you and you would convey that property back to me and it'd be an exchange. That created all kinds of problems. You could say, well, God dang, all I wanted to do was buy your property. I'm worried about environmental problems. I'm worried about all kinds of stuff. I'm going to have to hire a lawyer, That's why y'all see that language in the purchase agreements about, oh, the seller's doing an exchange. The buyer shall cooperate, but the seller is going to indemnify the buyer and it's going to be at no cost to the buyer. All that stuff's left over from the 80s. It doesn't need to be in the purchase agreement. Now, in 1991, the IRS said, okay, y'all can start using intermediaries. That's what my company is, an intermediary, all right? And you sign some documents, and I don't need the buyer's participation or cooperation to do an exchange. I mean, you just sell the property to the buyer, the money gets escrowed, the buyer goes home, and then I turn around and buy a property from a different guy. And by using an intermediary, I'm treated as if I conveyed property to the intermediary and acquired property back from the intermediary, so it's treated as an exchange. So you don't have to put the language in the purchase agreement about 1031. You don't need the buyer's cooperation, so why do you have to put language in there implying otherwise, okay? But if somebody is actually conveying, if I'm conveying property to Jeff and Jeff's conveying property back to me, you don't need an intermediary, right? I don't need to draft documents, and I tell people that. You don't need me. Now, that is a 1031 exchange, and the CPAs like Wilkins Miller, they got to attach a Form 8824 to your tax return. But you don't need me. You don't need an intermediary. You give him a deed, he gives you a deed, it's over. Now, if cash changes hands, whoever got the cash is going to have a little bit of gain, a little bit of tax, okay? Let's talk about how gain is computed. This is misunderstood by a lot of people. And I got to give you some facts. Let's say I buy a piece of property, a rental house in Fairhope for $100,000, all right? And I sell it for $300,000. And I don't do an exchange, all right? My income tax basis is $100. I sold it for $300. That's my amount realized. The difference between those two numbers is $200,000. If I don't do an exchange, I've got a $200,000 gain showing up on my tax return, right? Right. If I've taken some depreciation deductions on that property, some of it's going to be a higher rate than just long-term capital gains rates. It might be a 25% rate to the extent of those depreciation deductions, okay? Let's change the facts. I buy it for $100, I sell it for $300, and I do conduct an exchange. I escrow the money, sign the 1031 documents, and within 180 days, I go buy a property and spend $300 or more, all right? I sold for $300, I spent $300 or more on the back end. How much of that $200,000 gain shows up on your tax return? None of it. That's what Section 1031 says, all right? Let's change the facts. I buy it for $100, I sell it for $300, and within 180 days, I go out and spend $280,000 on other property. All right, I sold for $300, I bought for $280. The difference between those two numbers is $20,000. So $20,000 of my $200,000 gain shows up on my tax return. And the other $180 of the gain is deferred under Section 1031. And people say, well, wait a minute, I had a $100,000 basis in the property. Can I offset the 20 with that? No, because your $100,000 of basis is sitting over in the new property that you bought, okay? Let's change the facts. Somebody buys a piece of property for $100, sells it for $300. They call me, and we punch out the documents. They escrow the money. They identify a property in 45 days, and they buy something within 180 days, and they spend $100,000 doing it. How much of the $200,000 gain did they defer under Section 1031? None. Okay? None. They sold for $300. They bought for $100. The tax consequences of the sale are exactly the same as if they bought nothing at all. That's a fun conversation to have with people. You didn't tell me that. Yeah, I did. You didn't read my letter. And now my letter says, this is not fine print. All the quotes that people say when they get mad at me. Well, I didn't read that. Okay. But another way to say it is in my example, if my income tax basis and what I'm selling is $100,000, okay? For every dollar over $100,000 that I spend on other property, I'm deferring $1 of gain. If I don't spend more than my basis within 180 days, I hadn't even changed the tax consequences of the sale. And a debt payoff doesn't matter. Everything I just said to you is true, whether there's a debt payoff showing up on the seller's side of the closing statement or not, okay? So let's say in my example, you buy something for $100, you sell it for $300, and there's a $200,000 debt payoff showing up on the seller's side. And so the closing agent wires $100,000 to me. It's still the $300 that you've got to reinvest to pay no tax, okay? That debt payoff doesn't matter. And when you go buy something for $300, all these people say, oh, well, the debt has to match, blah, blah, blah. I just say it, hey, you got to go spend $300. It doesn't matter where the cash comes from. You can borrow it or you can spend your own cash. That doesn't matter. You can pull it out of your Merrill Lynch account. You don't have to borrow money on the back end, but you do have to spend $300. if you want to defer all the gain. There's reverse exchanges that you wanted me to talk about. That's a different type of exchange. Sometimes people call me up, and by the way, I've seen the real estate market come and go 4 times over the past, almost, I guess, 35 years. It comes and goes, and I know when it's starting to go, and that's when reverse exchanges start going through the roof. Okay, I probably got 40 reverse exchanges going on. That's people calling me up. Hey, Gil, I've got this great piece of property that I know I'm going to sell soon, but this other piece is I got to buy it right now. I'm going to go ahead and buy it now, and then I'll sell my other piece, later. That's a reverse exchange. I mean, you can structure it to where you buy the new property. That starts a 180-day period, and if he sells the relinquished property within 180 days, it'll work. But my point is that when the market starts crashing, a lot of those reverse exchanges end up failing, because they end up not being able to sell what they thought they were going to sell within that 180-day period, and they end up just owning 2 pieces of property. And so, the market is slowing down a little bit, but I mean, it's still gangbusters, man. I had never seen it. I shouldn't say that. I have seen it like this before, but it's been strong for the last 3 years. I thought it'd be lights out when rates went up, but it hadn't been. We've really been extremely busy, and I'm surprised about that. But a typical reverse exchange, I'll just say this. Reverse exchanges are not allowed. You can't buy the new property before you've sold the relinquished property. That doesn't work. So when people talk about a reverse exchange, what that is they've structured it in a way that the IRS says that's okay. And generally what the client has to do is sign a little document called the Qualified Exchange Accommodation Agreement. And in that document, they appoint my company as their title holder, it's called, sort of like as trustee or agent, but it's called title holder. And then when they get ready to buy that new property, my company as title holder has to temporarily take title to the property. And I can do that 2 ways. I mean, the grantee and the deed can be my company as title holder for Jeff Kent. That's one way to do it. Another way to do it is I can form a little single member LLC up underneath my company. He can be the manager, but my company temporarily would be the sole member. And then that LLC would buy the new property. But one way or the other, you got to park it with the title holder. Okay. And then that starts the 180-day period. Hopefully 3-4 months later, the guy calls me up. Hey, I'm now getting ready to sell the property. All right. That's when he's getting ready to do a 1031 exchange. And I punch out the documents, send them to the closing agent. That deal closes, the money gets wired to me. But 5 minutes later, I deed the replacement property back to him. Now, if I've taken title straight up, instead of forming an LLC, I've got to record a deed back to him. If it's $1 million piece of property, it's going to cost $1,000 to record the deed, right? If it's an LLC interest, all I do is assign back to them the membership interest in the LLC, and that's free, But there is a cost to form an LLC. But I'll say, hey, are you in the mood to have an LLC? Yeah, the LLC's fine with me. All right, well, let's form one. That way we won't have to do a deed on the back end. And but that's how those work. And then a typical reverse. I mean, I'm always going to say, hey, they say I'm buying a commercial building for $1 million, and I want to do a reverse exchange. I mean, one of my first questions, the first thing I'm going to want to know is the property that you're selling, how is it titled? Is it you and your wife? Is it an LLC? What is it? I got to figure out who I'm acting as title holder for. But my second question is, do you have the money? Or is there going to be a lender involved? And if he says, well, no, I don't have the money, there's going to have to be a lender. Well, in a perfect world, we'd be going to a bank saying, hey, we need a bridge loan. I want you to loan $1 million, for this closing, preferably the whole $1 million. He can make it interest only for 1 year with a balloon, just a bridge loan. Because the goal is, to sell property within 180 days, get the money, pay down the bridge loan. I convey the new property back to the fella, and then he gets his permanent financing on the balance of the debt at that time. Turn it into a permanent amortization schedule after we've paid it down. And if the lender, obviously the lender is going to want to take a mortgage on the new property, but if the lender wants a mortgage on the property he's trying to sell, that's fine. And of course the client's it's the client borrowing the money. Sometimes I have to mortgage property to secure the note that the client signs. That's called an accommodation mortgage. I'm giving the bank a mortgage to secure somebody else's debt. But that's how it goes down quite often. Or if the client's got the money, he can just shoot it straight to the closing agent. And then on the back end, when he sells property, I'm just returning the money back to the client. Okay. Improvement exchanges. Sometimes people say, hey, I'm selling a property for, $1 million, and I want to buy this dirt over here for 200 grand, and I want to construct improvements on it for 800 grand, all within the 180-day period. That's called an improvement exchange. You have to structure it kind of like a reverse exchange, because one thing you can't do is take exchange money and construct improvements on something that you already own, okay? So you got to spend the money before you own it. So again, you close the sale, escrow the $1 million in this example, and you've got to, hire my company to be the title holder, and then you have to park the replacement property with the title holder. And if it's an improvement exchange where there's going to be people out there hammering nails, in all likelihood, I'm going to form an LLC. That way if somebody wants to sue the owner, they're not suing me. They'd be suing this LLC. But you got to have your ducks in a row because you're on a 180-day fuse, So in a perfect world, you'd close the sale, escrow the money, buy the dirt, break ground, start pushing dirt around the very next day, Now, improvement exchange, it doesn't have to be a brand new building. It could be somebody buying timberland and wanting to build a dam or fences, or, it could be somebody buying a rental house, wanting to put a new roof on it and, spend $50,000 on the rental house. You can spend money on any kind of improvements, but you're on a 180-day fuse. I've got to give that piece of property back to you within 180 days after the sale. So only the monies that you spend on that property within the 180 days count. And any money that you spend after the 180 days finishing out those improvements, they add to your income tax basis in the property, but they don't get taken into account for purposes of computing whether or not you got gain under 1031. And so, again, the building doesn't have to be finished, but only the monies that you spend. And then people call me up, okay, Gil, I know I'm creeping up on the 180 days, and I've talked to my contractor. I'm gonna go ahead and get him $150,000 this afternoon. Well, not only is that just not good business sense, but there's actually a 1031 regulation that says that you're not supposed to prepay for improvements, okay? If you prepay for stuff, you're deemed under the regulations to have spent money on the people that are out there hammering nails instead of being deemed to have actually spent it on real estate. So that's about all I jotted down initially. And yeah, I've got a son that I need to go pick up from school. I'm supposed to be in Pensacola at Escambia Westgate at 1:30, and I'm an hour and 1 minute away. So I need to go soon, but and it's 12:20, it's 12:17. But does anybody have any quick questions? I'm probably going to scoot in just a few minutes. But anybody have any? I know I went really fast. I'm sorry. Yeah.
Question. So I always thought that there was a defined time period, but if you're holding a property for investment, what's the?
Okay, good question. The only thing I can say is, look, first of all, my law firm doesn't give opinions on whether or not something's been held for investment. I skate on that issue. So my documents assume, and my final letter assumes, hey, looks like a clean exchange, assuming that what you gave up had been held for investment, and further assuming that what you acquired was acquired with an intent of holding it for investment. So all I'm left with is having structure. The answer to your question, though, is there's no specific period of time written in stone beyond which it definitely works or short of which it definitely does not. You hold something for 1 year and sell it, yeah, that's long-term capital gain, unless you've got depreciation deductions. But there's nothing under 1031 saying you have to have held it 1 year in order to do a 1031 exchange. Hypothetically, and this happens, somebody says, I bought this piece of property with every intention of holding it and renting it out. And dang, if it wasn't 2 weeks later that the next door neighbor came up to me mad saying, I cannot believe they sold that piece of property to you. I've been trying to buy it for years, and I'm making you an offer that'd be stupid for you to refuse. That actually is a candidate for 1031, even though he might have only held it a month. It's a factual issue based on your intent. And, and I would tell that guy, hey, the way you just described it, which may or may not be true, but if the facts are as you described it, I think that's a candidate. That's your argument. You got to stick to that always. And then on the back end, you got to buy something with an intent of holding it for investment, not with an intent of gifting it to your kids, not with an intent of soon thereafter putting it in an LLC. You got to buy it with an intent of holding it for investment, not with an intent of buying it, fixing it up, and flipping it, But there's no specific period of time written in stone. Sometimes people will buy, a nice house and rent it out, and man, people are stealing their forks and knives and everything else. And a year later, they call me up, hey, we don't want to rent it anymore. And in fact, we like Dolphin Island, and we're thinking about moving there. We might move in. Is that going to adversely affect our exchange? And I'll say no. I mean, if those were the facts, you bought it with an intent of holding it for investment. The photograph is taken when you bought it. You know, and here you are a year later changing your intent to personal use, but that doesn't necessarily adversely affect the exchange. I mean, it's you take the picture on the day you buy it.
Great, thanks.
But am I talking too loud?
You're probably doing just great.
Okay.
Anybody else have any other questions?
I have a question.
Okay.
This is overwhelming. What you do is overwhelming. And my thought, and I've seen a couple of 1031 exchange companies get up and talk in the last few weeks. My observation is you guys need to have a consulting arm to your business, and you need to charge people and handhold them through this process. It's a lot. And I think you're leaving money on the table if you don't have a consulting side of the company where you charge them for the transaction fees. Great.
Yeah.
But if I'm doing this for the first or second or third time, I want to make sure that it's done correctly, and I'd be okay paying you extra money to walk me through that process.
Yeah, that's a good idea.
Just a comment.
I could offer that additional service, sure. And I do a lot of consulting. I mean, I pretty much all day long, every day, for free. And you know, but yeah, I mean, every 1031, well, not every, but a lot of them start with a conversation, and a lot of those conversations end with me telling them it doesn't look like a candidate, and I don't charge people for that either. You know, it. Last thing I want to do is see somebody do it, you know, structure it as a 1031, and then it, for one reason or another, it doesn't work. But anything else? That's actually a good idea.
This is probably a one-on-one question. It just popped in my head, but the investment property that we're selling to do the 1031, that doesn't have to be in an LLC, does it, or does it?
No.
It can be in our personal
any
names?
Kind of taxpayer can do an exchange. I mean, it might be a trust selling it, husband and wife, LLC. You know, but you got to think in terms of tax ID numbers, and you know, whatever tax ID number's been holding it, you generally that same tax ID needs to be the buyer on the back end.
Okay.
And now, you know, like if a guy sells a piece of property, and then he wants to buy a replacement property in the form of a single member LLC, that's fine. Okay. You know, because a single member LLC is generally disregarded for income tax purposes from the IRS's perspective. It's as if it doesn't exist. So, you know, single member LLCs are generally the same thing as a human being.
Right.
You know, but if somebody says, you know, if a guy says, I'm selling something and I'm going to buy a replacement property in an LLC that's owned by me and my wife, that ain't going to work. You know, because that's a multi-member LLC. It's treated as a partnership for income tax purposes, and that's a different tax ID number, you know?
All right, so my wife and I, we have our condo for sale. We want to do a 1031. The deed is in our personal name, but for financing and taxes, we have an LLC with EIN number. Is that okay? And I'm the member.
I don't know. That's got a little hair on it. I'd have to get with your CPA and ask the CPA, hey, are you treating this as partnership property or not? You know, if he says, no, man, I'm not treating it as partnership property, then that means it's you. But if he says, yeah, man, I've got it on the books of the partnership, well, then even if it's not titled in the name of the partnership, from an income tax perspective, it is in the partnership.
Okay.
And
it's a little hairy. Okay.
Anyway.
Yeah.
All right.
Sorry.
Give him some of that consulting money.
Yeah.
Yeah.
I don't know, man. You know, another thing, I'm a tax lawyer. I do all the other stuff that tax lawyers do as well, like wills and trusts and LLCs and corporations, and that's what I'm supposed to be doing all day. This 1031 stuff was generally just kind of a hobby. When I can remember being at the country club saying, you know, I'm involved in 15 exchanges. Can you believe that? You know, and it just kind of comes and goes with the market. And when it's really busy, my sister Alan, she handles a lot of that air traffic control, talking to closing agents, and that frees me up to be sane and kind of focus on all the other stuff that I have to do. And I've got some good help. So, all right.
I was wondering if you can extend any of those deadlines, and what happens if you don't close.
The only way they get extended is when there's a hurricane. You know, when a hurricane comes in, you know, there's usually an extension in the devastated area, and you kind of get to kick over the 180 days through the extension period, and that's a total cluster when that happens in my world. But
what happens on day 181 when you didn't close? What happens on day 181 and you haven't closed? What happens at that point?
You're hosed. Yeah, you got to get a deed within 180 days. You got to close. You got to acquire. You got to close on the property. So if somebody says, "Hey, I'm selling a piece of property for $1 million, and I'm gonna buy a unit in Phoenix 35," you know, well, I'm going to be saying, well, when are they going to have a certificate of occupancy? When are they going to be able to give you a deed? 3 years from now. So you got to get a deed. You got to close within 180 days. So, all right, guys, I got to scoot.
Thank you, Gil.
Sure.
Okay, let's go to maybe Jeffrey, and then let's do 5 or 10 minutes on your stuff, and then we'll go to Rob, and then we'll have a discussion about more tax stuff.
Yeah, for sure. So Gil hit on a few things that I'm going to talk about. Just want to give an overview of just tax overall. There's a lot of this stuff is very fact specific, very a lot of just based on how it looks and everything, but there are like 5 key kind of areas I want to talk about. So the first one we talked about the basics over there. We talked about entity structure. So a lot of times, if you hold a property personally, you just report that directly on your individual tax return, things like that. Once you get into LLC, if it's single member, like Gil was talking about, it's reported directly on your income tax return because it's disregarded for tax purposes. Then once you get multi-member, where they want to have real estate in S corporation. So you'll see some things. There may be some operating business. You maybe want to be an S corporation, but there are some restrictions with real estate and S corporation. So you really want to be careful of that. Normally don't see that. Another thing, just the basics, is bookkeeping. Just kind of keeping your income, your expenses, your balance sheet, what it kind of looks like for your property, all your properties. You want to keep that up to date. You want to make sure that's good. One thing we see a lot is people that if they don't know, they're expensing their entire, mortgage payment or entire loan payment. Only that interest is deductible, and the principal part of it just reduces your loan. So things like that. We've seen plenty of times where if money's coming in, it gets coded incorrectly. It's not really rental income. It's a contribution of capital or something. We got to clean it up. You just want to make sure that stuff's all cleaned up. Your bank account is reconciled, everything like that. Another thing back to the loan is the interest expense. A lot of people, will get it at the end of the year. We want to tie out the loan balance to the ending loan balance from the bank. And you want to make sure your interest is correct because that is deductible against your rental income and all your other expenses. So the next kind of step is the property specific. And so a lot of it is tied in with depreciation that Rob is going to talk to over here. So big thing is whether you expense something, which means you completely take it against your rental income 100%, or if you need to capitalize and depreciate it, things like that, whether it's improvements to the properties, things like that. So what Rob will talk about is when you're capitalizing and then depreciating it and how you accelerate the depreciation. But on the front end, if you're really just restoring something back, it can really be just a repairs and maintenance. So there's some specific safe harbors on that and what the IRS has said. There's one thing too with insurance as well. Say you have roof damage, something like that, and you got to replace the roof and your insurance pays for it. You may not have to capitalize your roof. You can offset that expenditure with your insurance money because otherwise you're having to take in income as insurance money and then depreciate over 27 and a half or 39 years of depreciation. So that's something to do with insurance. The placed in service date is a key part for when depreciation starts. So Gil talked about the certificate of occupancy. That's something that's real important of when you can start depreciating your property. It doesn't have to always be when you start getting rental income. It can be when it's ready and available for rent, which is a gray area. So there's a lot of different cases and regulations and things like that. The certificate of occupancy is something is really big. I'm sure that's a big part of Rob's business, especially at the end of the year. A lot of times we'll see we can get it placed in service on 12/28. Well, you can get depreciation for that whole year. It's really based on, so that can be a good tax saving tip. The next step I want to talk about is investor specific. So when you get to your actual individual return, there's active income and losses and passive income and losses. So at its base level, real estate is called passive loss. Unless you're a real estate professional, and there's a lot of different hairy things there, but the real estate professional status is something which I may have heard about, where it can turn your passive losses to active losses. Now, there's some very specific rules on that, hour thresholds, how much time you're spending, just everything like that. So that's a point where I've seen a lot on social media. People talk about doing that for real estate to offset your active income. And it is a thing you can do. You just got to be very careful. We've had an audit where it was questioned recently. And man, this guy was involved in a lot of different real estate, and that's all he does. That is his full-time business. And the IRS, they asked for a log of his time, his credit card statements, his bank statements, his calendar, his phone, text messages, all that kind of stuff to try to prove that he was truly a real estate professional. So that's a big part. Just be careful there. Make sure we talked about the calendar earlier. That's a great tip for a log of your time if you ever were questioned by the IRS. There's also an election you can do if you've got multiple different rental properties or things like that to group them as one rental to meet the thresholds, which is something you've actually got to make that election. The IRS asked for a copy of that election as well when we were audited. Luckily we had it, everything was fine. It was a big headache. Glad we had it though, because if it hadn't been, it would have been very negative for the taxpayer. The other thing is the short-term rentals, heard a lot about. There's some special rules there, especially if it's under 7 days or less is your normal rental period. And then if you're actively managing that property, if you just kind of do a property management or VRBO, Airbnb or something like that, you may not be able to use this. But if you're actively cleaning and managing and booking and setting prices, that may be active losses as well. Kind of a special thing there with short-term rentals. One thing with personal use of property, people have beach property or something like that. One thing you can do is if you don't use the property more than 14 days a year, then you can still take the full expenses and everything like that for the whole year. You don't have to allocate anything to personal. So if you have a beach condo, you just try to be under that 14 days a year, and it makes it a lot easier. It's a question we ask for a lot of our clients that have those beach condos. If you get above that 14 days, then you have to kind of allocate between personal rental use, and it gets a little more complicated. One thing Gil was also talking about was held for investment versus flips. So the IRS calls it investor versus dealer. And it has once again, it's very facts and circumstances, but has some very big tax impacts. An investor, when you sell something, besides your depreciation recapture, which I'll get to, is capital gains because it's held for investment. A dealer, if you're doing a bunch of flips, the IRS may call it like this is your business. This is ordinary income that you're doing, subject to ordinary income tax rates. And that's where the highest ordinary income tax rate is 37% and the highest capital gain tax rate is 20%. So big impact there. And also, if you're the dealer, you may have to pay self-employment taxes as well on that, which is another hit. So on to the gain deferral and recapture. So cost segregations and 1031s, we see a lot with our clients. It's a great strategy to really advance the tax savings and a cost seg opportunity, and for 1031 to not have to pay the tax right away. The biggest thing there, and Gil mentioned a lot, is that it's a deferral of tax. It's not an avoidance. It's something we have to explain to our clients a lot, especially with cost seg studies. Because the main thing you're doing is you're accelerating depreciation to the year that the property was placed in service. So we had one instance where it was a large shopping center. I think it was 2016. They did a cost segregation study, millions of dollars of depreciation deductions. And then they turned around and had a great deal in 21. And they made lots of money, did great on it. And we kept telling the client about how much it was going to be in taxes because their tax basis was way lower than what they had originally paid for it because of that depreciation deduction. So something just be mindful of is consult your tax attorney or your tax CPA when you're going through these transactions. What's going to be my total cash after that? Because that tax hit was big. Even though we try to communicate it way in advance, sometimes it's hard to get across. Another thing, one mind part is there's nothing certain besides death and taxes. So at death, the way that the law is currently written is that if you hold a piece of property and it passes to your heir, that heir gets a step up in basis to the value. So that, it's not really a planning opportunity. You don't want to plan for death or something like that, but it is something to consider when you're holding property for, it's structured in your will and things like that. Your heirs get that step up in basis. You don't want to sell it to them or gift it to them. You may just want to hold on it till the end. Of course, there's lots of situations there to think about, but just something to consider. And then finally, just kind of overall tax is, the CPA's favorite phrase is it depends. So once again, lots of variations. Social media is very big with things, and especially real estate, because there's a lot of tax opportunities. But like I said, be very careful and mindful of your specific situation. And with that, I've seen a lot of things that overall it sounds good, a headline or something. But then if you really look into it, there's a lot more that has to go into it to be able to get a favorable tax status. One other thing I want to mention was like business expenses that you have. The main thing for it is ordinary and necessary is the wording from the IRS. Once again, kind of a facts and circumstances case. There's some specific rules on specific expenses they've had, whether, meals are only 50% deductible now, entertainment is non-deductible, but anything, we get the questions a lot about phone and mileage and that kind of stuff. And if it's for business, there are certain rules that you can follow to have that deductible. So the biggest thing with that is keeping receipts, keeping logs, because the burden of proof is on you if the IRS ever asks the question. Kind of like I was talking about that audit. If they ever came calling, they may ask for a lot of stuff. So if you have it documented now, it's going to make it a lot easier. And then finally, wanted to mention one little thing is, it's not a little, it's going to be a big thing, but so President Trump back in 2017 had a big tax law change that went into effect, I guess it would have been January 1st of 18. A lot of those rules sunset, which means they expire December 31st, 2025. So the 2026 tax year is going to have some big changes. I think it was Tax Foundation, some group that I follow, they said if nothing changes, taxes will go up for 62% of Americans. A lot of key bonus depreciation is continuing to phase out. So that'll be zero at that point. There's also qualified business income deduction is a big thing. And then there's a state tax exclusion piece of that. That's going to be a big piece. So taxes are going to be a big piece, with this election. It's been already talked about if you've been following that. And then for the next year, 2 years, it's going to be a lot of back and forth. So we're following the election to kind of have an idea of who wins, who controls what, and what may pass. So just something to keep mindful of. Tax law is always changing. So one thing that worked 5 years ago may not always work. So just to be mindful and stay up to date. So I'll take any questions as well. That's kind of all I had prepared, but I appreciate y'all's time.
Are you looking for new clients?
Yes, we're looking for more new clients. We really are built, we like the commercial space overall, and I think I said in the earlier, we're really built for the complex kind of thing, but we'd love to listen and talk with everybody because we'd love to help. I love to just share knowledge too because it is something I'm passionate about. I'm a tax nerd. It's fun.
Awesome. Thank you.
Thank you.
Can I ask a question?
Yes.
So when you turn a personal property into like a long-term rental and you're looking at property improvement to get it ready for rental, how does that work? And maybe he's shaking his head, so maybe that's a question he can answer too.
Yeah, that would add to your basis and everything like that. And then, so if it's truly for the business purpose, then so like your original basis in the property and then whatever improvements you've had, you could start appreciating from there.
Okay.
Yeah. Okay. Good question.
Thank you.
Mm-hmm.
Hey, I'm Rob Schell. I've been a cost segregation specialist for about 10 years. I really want to kind of talk to the room here a little bit to kind of start off a couple of things. To get this out of the way, you have contact information in the handouts Maura provided with my business card on it. That has two different things in it. It has an email address, a URL for my website. On my website, there's a section in FAQs with 32 cost segregation questions and 1-minute video answers with me answering them with 1 minute. So you guys can, within a very quick, efficient amount of time, get your answers, you get your questions answered very quickly through my website without a lot of pain. Secondly, there's a QR code on my business card that flows right to a link on my website to generate a proposal, and you would have a proposal for a cost segregation study within 1 to 2 business days by submitting that. So you have that information in front of you if that was of interest. Happy to pick up the phone, talk to you anytime. I'm a real casual guy, want to help you out, want to make you as successful as possible and provide you with the best possible knowledge in the marketplace I can. And in some cases, that means you don't need to be working with me right now. Call me in a couple of years when you're ready. And that's how I'm building my business over time. A lot of things, there's 2 reasons. How many people have done cost segregation studies in this room besides you? Okay, so so a few of you know what it's about. How many think you may be in that market in the next 1 to 3 years? Okay, so there's 2 reasons not to do cost segregation. Number 1, if you have pent up deductions already, and a lot of newer investors have a lot of deductions and business write-offs that they've created, just the nature of starting a business. If you're in a position where you're not going to be cutting a check to the IRS in the next year, really there's no reason to kind of connect up with me right now. You'd have to pay me a fee to create deductions that are just going to be sitting there on the bookshelf until you're ready to use them. It's not wasted money. They're ready for you when they're ready to be used through a cost segregation study, but engage me when the timing is more appropriate. The second reason is I heard there's some flippers in the room. If you're flipping property, which was kind of explained earlier a little bit, there's recapture from the IRS on any kind of a cost segregation study. So the rule of thumb is you need to be hanging on to the properties in your mind with at least a logical flow of time of 3 to 4 to maybe 5 years. If you can kind of hit that gauntlet in your mind and go, yep, I'm going to keep this property in service. It's going to be in my name for 3-4 years. And then, I'm going to open up a checkbook and cut a check to the IRS in about 6 or 7 months because I know I'm making a crap load of money and I know I'm going to have to pay the IRS. Those are the indicators. And if you have commercial real estate, and it includes single-family homes, condominiums that are short-term or long-term rentals, then that's a good indicator to reach out to me and start the process to understand if I can help you out, okay? And then absolutely, in my world, there's a dotted line between you and I as the investor and a cost segregation provider. There's a dotted line to your CPA or financial advisor that's filing your taxes for you. They've earned a seat at the table. They need to be at that table helping you make the decision on if this is good business strategy, because I don't know your personal situation financially, and that most CPAs should publish a book on their clientele with fake names because they know a lot of interesting things about people, and it's kind of a fun thing. But they really know you better than I do, and there's things going on in your life that they're going to be like, 4 out of 5 times, if you meet the criteria, they're going to say, yeah, go for it. Go for this cost seg study. You're going to relieve a portion of you're going to make my life easier because a third-party company arm's length transaction is doing this work for me, the CPA, and also it provides an insurance policy for that CPA, because God forbid if there was ever an audit, and cost segregation does not raise red flags with the IRS for an audit. It's actually a process that tells the IRS you are an organized professional real estate investor utilizing the law in the correct way, and you're doing it correctly. You're doing something else that the IRS wants to dig into. But if there was ever an audit and you worked with our company, based on the fees we charge you up front, the audit, we would provide audit defense at no additional charge. And what that means is we would engage with your CPA, be part of that defense to be able to go through the portion of the audit that is the cost segregation study only. And that could be phone calls, Zoom, in person, a change of documents, make sure that they understand what we did several years ago with the cost seg study. And we get thrown into probably 4 to 7 to 8 audits a year. We do several thousand studies a year, okay? My company is the largest in the industry. And if you put the number 2 and number 3 companies together as far as size of how many projects they do, that would be less than half the size of our company. So we're the 800-pound gorilla. There's 150 independent reps in the marketplace. Rich is an independent rep. Lauren, that was here last month, is an independent rep that is starting to become my partner. She and I are sharing cash flow and some of the revenue stream that I'm building up, and I just don't have the time. And she's becoming a junior partner of mine to kind of take care of the flow and the day-to-day transactional things for me. So she's becoming my business partner, but she has the exact same business model that I have through CSSI. Okay, so those are the reasons you would engage me for a cost segregation study. Why would you want to do this? Well, for every $1 million in commercial real estate, a cost segregation study can help you cash flow, give or take, about $100,000 or 10% of that $1 million. Sometimes it's $80,000. Sometimes it's $120,000. It depends on the type of asset you're working with, but a good kind of a rule of thumb is about 10%, give or take, okay? And it comes to you not in cash, but it comes to you in the form of a deferred federal tax deduction. And what Jeff was saying is, this is your money. We're just providing a mechanism through the IRS tax laws that allow you to unlock about 10% of it early. Why not have your money working for you freely for yourself rather than having the IRS hold on to it and doling that out over 27 and a half years or 39 years, depending on the kind of property you have over time. It's time value of money. Have the money working for you on an ongoing basis. Pay a company like mine a small fee to unlock that structured money for you in your tax return. Okay, so that's what cost segregation does. On a low level, let's talk about the high stuff. I work with a lot of very, very large companies. And in this marketplace, I'm allowed to talk about a few names. Gulf Distributing Holdings, the big beer distributor, they bought the Mobile Press Register building downtown. I'm doing that. It's a 4-year project for cost segregation and improvements over 3 years. They're putting about 100,000 square foot on the back of that building and turning it into a massive beer warehouse. Plus there's a 3-story office building in the front. In addition to that, there's a 179D energy project that I'm working on for deductions for that specific building. And that'll be about a 2-year project that'll start in about a year. That's significant. And then so that's a really big project, and I work with a lot of their warehouses for beer distribution all over the Southeast. There's a company called Trinova in Mobile. I'm working with that company. We just did a big cost seg study for them, and then also we're doing we just completed a 179D project for them on energy as well for that building. We're now working on a research and development tax credit project for that specific company as well. Okay, so I'm into a lot of different things, not just cost segregation. Rapid deployment, I don't know if you know that company in Mobile. To give you a scope and idea of the size of that company in this little area, I'll be doing their airport hangar that's in Fairhope that houses 3 jets and 2 helicopters this year. Okay, so, and those are for the owners. So kind of a interesting little company there. I'm working with 2 companies in Mobile that I'm not allowed to use their names, but one's a military contractor that builds ships. And another one is a big depot that builds aircraft. And I'm doing 179D energy projects for both of those companies on a national basis, okay? One of them has multiple locations all over the country. Let's talk about the low level of what cost segregation can do. For the smaller investor, it starts at about $200,000 to $250,000, okay? If it's an $80,000 house you bought, you're fixing it up, you're putting $20,000 into it, I can't help you. The ROI on what I have to pay, what you'd have to pay me, and what the balance of what you'd get in a deduction, it's just not in the range of what I can do. So in your mind, you need to think, okay, does it hit the $200,000 delta from a cost basis perspective, okay? And so cost segregation, again, is, not again, but it's an allocation that is, you have to allocate a portion of the property for land value, and we have to subtract out the land value. It's focused just on the building, the actual building structure. And what we're doing in cost segregation is we're collapsing the straight line depreciation model, the 27.5 year if it's housing, or 39 year if it's everything else in real estate. And what we're doing is we're creating 5-year, 7-year, 15-year buckets of property. And anything in the room, from lighting to ceilings to flooring to walls to windows, everything has an allocation based on those feature sets, roofs, parking lots. And what we do is we scour all the assets in your specific building and property and then flow it through to a 5-year, 7-year, 15-year schedule. And in so doing, we're compartmentalizing the values of these buildings and then providing them in a report that the IRS will accept and coming up with one number. And Jeff loves the report, but all he cares about is one number. It's a 1/4-inch thick document. He's like, where's the dang number? There it is. Pull it out, puts it in the tax return. He knows that a cost segregation study does what it's supposed to do, and he's got the formalized backup if, God forbid, there was ever an audit, okay? But he's looking for the one number out of that document, okay? And it's gonna be that for you, based on your tax rate, 32%, 37%, it's going to be, you're going to be getting a deduction, a deferred deduction that offsets your taxes in that current year. Let's say it's a $1 million house, and you have it on a long-term rental basis, and we find you on just round numbers, $100,000 in deferred deduction, and that calendar year you owe Jeff and the IRS $80,000 in taxes. In that specific year, you're going to pay zero to the IRS. The $80,000 is going to be taken off the $100,000 we provided you, and you have $30,000 left over, which is carry forward to the next calendar year in your tax return, setting you up beautifully for next year. Okay, so it's a tax strategy that has the potential, based on the assets you have in commercial real estate, that can have you not paying federal taxes for a season that goes even beyond a year. And if you start to get the drift of how good this could be, all of a sudden, I'm kind of like a drug pusher. All of a sudden, it's like, ooh, I'm hooked, but I just ran out of all my deductions. I got to go buy another property so I can go talk to Rob and do another cost segregation study because I've got a problem next year. And so it starts to feed itself. And I see clients that are right now going, hey man, hang on. I've got 4 more months. I got to buy a property by the end of the year. And I was like, yeah, and you got to put it in service too. And it's got to be in service by the end of the year. And then we can start to work on that project for next year. And I just finished up cost seg studies for this exact customer I'm thinking of. So I'll kind of take a breath and kind of breathe a little bit here and maybe take some questions about how I might be able to help y'all.
Yep. I had a question about the acquisition of a property, say a commercial property, non-residential, and it's in service when you get it. You have tenants, people are paying rent. But then you're also going to do improvements to the property. How does all that relate when you do a cost seg with as far as CapEx, in service, and the acquisition?
Okay, so you're in retail. So the day you buy the property, more than likely it's in service because you already have tenants that you inherited. So the day you buy the property, it's in service. So that's your start date. The IRS doesn't care about the day of the month, but they do care about the month and the year. So they're going to start with that timeline. Okay, and that's the timeline of where you start to do the cost seg. Improvements, as long as, so in your world, it depends. If they're leasehold improvements from that the tenants are doing, you can't claim that in a cost segregation study. I can do a separate cost segregation study for that tenant of yours for leasehold improvements. And I don't do those very often. I've done a couple, and they tend to have to be longer term leases. What I've seen in that world is it's restaurants and they have long-term leases like 10, 15 years, and they put a big kitchen in. And that's like, $500,000 to $1 million for a kitchen, and they're leasing part of the building. Okay. That would make sense for them to do a moderate cost segregation study. But if you're doing the improvements on the building, then those absolutely qualify. First stab, and Jeff was kind of talking about bonus depreciation. That would all flow to bonus depreciation. Okay, so based on the current structure, 2 years ago it was 100% bonus depreciation. Last year it was 80. 2024 we're at 60%. Okay, the remaining 40%, if you did the improvements this year, would flow through to a 5-year depreciation schedule based on the improvements. Okay, but realize that of the 5 years, one of them's this year, so it's really 60 plus 1/5 of that for this year. So did I answer your question with that?
Just to clarify, so if let's say you bought it for $200,000, a small building, you put $100,000 in, it's in service, but that $100,000 was CapEx was spread out between last year and the $50,000 last year and $50,000 this year.
But it was your CapEx and you spent the money.
It was for the property.
So we do, as I mentioned with Gulf Distributing Holdings, we're doing a 4-year over time improvement project. And what we do is we take all the invoices for that year of all the improvements and we build out a cost seg study just for the improvements. Okay. And then but there's some left over for next year. Great. We'll handle that on 12/31 of the following year, roll up all the receipts and improvement invoices, and we'll do another cost seg. We bundle that in up front. We'll know that it's a phase 1, phase 2, phase 3 project. So absolutely, that's part of a cost seg study. And it just depends on when you're making those improvements on a timeline of the year.
Okay.
Make sense?
All right. Thank you.
Okay. Hi.
Hey, so
basic tax strategy and currently purchasing real estate has enabled me to consistently eliminate 80% of my tax liability. However, every single year I'll have like a $40, $50, $60, $70,000 gain that I'll have to pay tax on. Do you have like different tiers to the cost segregate? Like, let's say I just need to eliminate 50,000. Like you said, don't come to you if you need to, if you're not paying a lot of tax, there's no need to come to you. But let's just say I want to eliminate the remaining 50 grand. And let's just say I bought kitchenettes, $70,000 worth of kitchenettes. Typically that's a 5-year depreciation. Can I hire you to depreciate those $70,000 or $50,000 worth of kitchenettes year one, just to eliminate that remaining $50,000, $60,000, $70,000 gain?
If they're sitting in a storage unit, no. If they're installed and if they're in service, absolutely. So let me tell you a little story. CPA in Chicago, okay? This guy works with a lot of sophisticated investors, 100-unit portfolio of real estate strip centers. They're ugly as hell. You wouldn't want to buy any one of them. But if you have 100 of them, you're a pretty wealthy person. So what this CPA does every year, and I just kind of smile and kind of chuckle and go, okay, because I never know what he's doing. And he's like, okay, Rob, I need 7 studies this year. I'm like, okay, you need 7 studies. How many did you use last year? I used 3 of the 5 you gave me. So you have 2 left over. Like, why do you have them left over? He's like, and he kind of explained to me what he does. He said, my company takes anywhere from 4 to 8 weeks to do the studies. Okay. So when we lock in, there's like a back-end engineering process in our company to deliver the product to the CPA and you, the client. Okay. The challenge from a CPA perspective is the client isn't always necessarily giving them all the information they need to do the tax return until the last couple of weeks. And then it's too late to do another cost seg study. So what this CPA does is he orders extra. He orders more than he needs. Okay. And he knows fully in advance. He's kind of just paying a little bit in advance. He's keeping a couple on the bookshelf every year. Knows he's not going to use them all, but he's ready for that client when he sees that number. Okay, you're at $50,000. What do we have in the book over here? Okay, let's pull this one out. Okay, that'll take care of $40,000, and we'll take them down to $10,000. What this CPA typically does is he doesn't like to zero out these extremely wealthy clients because it's kind of a red flag for the IRS. So he'll have them it'll do 2 things. It takes their tax rate down to a degree with building cost seg into their strategy, but it also lowers the amount of money that you would end up paying the IRS. And it's really a relationship you have with a CPA that does all that integrated work on where he wants you to pay a certain amount of your income and where it's appropriate. Most CPAs don't like taking you down to 0 every year. It's probably not a good thing. You'll end up in an audit someday. So you want to pay a little bit. Okay. But that's really, that's coaching you need to get from your CPA. But so in your position, what I'd recommend is working with a CPA that'll have that kind of a strategy that can help you manage last minute tax implications to get you to the bone of where you pay the least amount, but paying a little bit.
Usually Q3 we'll assess where we're at and whether we need to do something or whatnot. But, with a small gain and whatnot, I've just been paying it where I truly don't feel like paying it. My mentors, they have hundreds of millions of dollars worth of properties and they're never paying. They're laughing at me because, I'm a flea in comparison to them. And, here I am paying taxes. Well, these guys are not. So I don't want to pay tax on anything if it's up to me legally and ethically. And then real quick, I had a second question and you could answer this. Maybe the CPA can answer this. Now, let's say I did do, a cost segregation that eliminated all of the taxable gain, right? But then I have, I bought 2 properties, invested $300,000 in capex. Can I take a 5-year capital expenditure and choose to depreciate it over 27 and a half years? Or must I depreciate over 5 years? Like I actually like snowballing and building up the depreciation so that I can, have massive tax-free cash flow coming in. You know what I mean?
Yeah, so you can't like change a 5 to a 27.5. Now you can elect out of bonus depreciation or something like that. So that's the big thing that we've been talking about this 5-year, 7-year, 15-year property is the ability to take the accelerated depreciation, the bonus. You can elect out of that and truly take it over the 5 years or 7 or 15. There's some specific rules, and I'm not sure right off the top of my head of how if you elect in the first year, I don't think you can undo it kind of thing. So a lot of times we see with our clients, they normally would just take it. And then, because a lot of those passive those losses that you have continue to carry forward, kind of that Rob was talking about. We see a lot of times.
Right. So if we did a cost seg study for you and it took you down to zero, and let's say we found you that $100,000 and you owed $80,000, realize the $30,000 remaining carries over to your tax return the next year.
Well, $80,000 gain, probably 15 grand in tax or something like that. Not.
No, I'm saying if we found you $100,000 in a deferred federal tax deduction, and you owed 80, and it wiped out your $80,000 tax bill, the $30,000 remaining on that previous cost segregation study carries forward to the next calendar year of your tax return. So it sets you up for the next year. Is it probably enough based on where you were the year before? No, you're probably gonna have to do another cost seg study for the next year, but at least you're 30,000 ahead. So you don't lose it. It just carries forward
Indefinitely, or
yes.
Okay.
You don't lose.
So you dispose of the property.
Right. Correct. And then talking a little bit about recapture, just realize there's a set of rules within cost seg, and some people are like, oh, I don't want to do a cost seg because I'll be in trouble later when I sell the property. Yes and no. If you know the rules, and I can help you, and if you forget the rules, call me. I'll remind you what's going on. But I'll tell you a little story. I got a young kid. I don't know where he's getting his money, but he buys like half city blocks in Chicago, and it's retail downstairs and restaurants, and then apartments upstairs, 2-story buildings. And I was going out doing site surveys with him a couple of years ago, snowy day in Chicago, and I'm like, Brad, I know you're going to sell this building in like 1 to 2 years. Why are you doing a cost seg study? So I'm kind of shooting myself in the foot because he's buying this thing for me and I'm almost talking myself out of the deal. But he was a good customer. He's buys a lot every year from me. And he just paused. He was kind of pissed off. He kind of looked at me and said, you know what? I don't care. He's like, when I said that whole 3 to 5 year window, that is the real way to do it. But this guy is an aggressive investor. He basically looked at me and said, I don't care. What you're doing is you're cash flowing me now with this specific property. What it does for me in my bank account is it pays for architectural drawings, it pays for zoning, it pays for my city permits. It gets everything ready for all the improvements I'm going to do on this building. And I'm doing 4 to 5 to 6 projects a year like this all over Chicagoland. And I don't care where the flow of the 3 to 5 year window of holding a property happens. If I'm selling this property in 2 years, I'm probably going to make a lot of money off of it. So I really don't care about any recapture. I let the CPAs deal with that. And I'm like, yeah, but you have multiple CPAs. It's like, yeah, I do. I have they're all in different cities too. And based on my partnerships, I have different CPAs managing my assets. So his position was cash flow's king. Keep the cash flow going. I'll let the CPAs deal with the nightmare on the back end with all my recapture. And in the end, I'm going to win 4 out of 5 times. 1 out of 5 times, I might be upside down with that cost seg study. And I'm okay with that.
Pertaining to recapture.
Just recapture.
Yep. So let's say, I accelerate the recapture of let's say that I do a cost seg to accelerate the depreciation, and then the property is not yielding any tax benefits to me and I have the opportunity to buy something else. I can 1031 that and not have to recapture anything, right? It's just going to be into the next property. Or is cost segregation a gray area?
There's a step up in basis when you move into 1031 with the property that you're selling to the new property. And there's a flow through of you're not paying the IRS back. It's like kicking the can down the road.
No, correct.
Okay?
So regular depreciation, if you collect depreciation for 10 years, you sell it, then you got to pay that 10 years worth of depreciation back. What I'm saying is let's say, I buy a property, I suck all the depreciation. I get all the tax, the 27 and a half years worth of tax benefits day one or year one. And then I sell the property, upgrade to something bigger. All of that recapture never comes back until I sell the next property.
Correct. You got to go into it flows through the next property, and then it sits there in that property. I'm correct with that, right?
Yeah,
it's a little more
the
definition.
depreciation recapture piece is a little hairy that we can.
It is.
There is some parts there, but that's the whole thing. Is a lot of people do the cost set, and then that's the whole thing. A lot of this is if you can 1031 and keep deferring the gain, and then like I said, if you pass and it gets a step up a basis, is that a long-term strategy with this kind of stuff can really be beneficial the way you leverage multiple strategies.
Right. Any other questions? Okay. All right. Well, thank you for having us.
Thank you so much. I have a couple little announcements, and then you guys can stay as long as you want to do some networking. If you could do me a huge favor, in your handouts, there's a survey, or you can scan the QR code and do it on your phone. But if you would fill out the survey, and let me know what you like or didn't like about the meeting. We're trying to make them better every time, so that would be great. Our next meeting is set for September 27th, probably here again, as long as people like the location. And it's going to be a creative finance workshop. I know that a lot of people have been asking for that. I'll talk about that in a second. We also have a private Facebook group if you want to join that. I'm hoping to get more interaction and maybe facilitate more deals on there. If you want to sponsor a meeting, talk to me or talk to Stacy also. Okay, like I mentioned, next month is Creative Finance with Zach Beach. He's coming all the way from Vermont. This guy's written 2 books about creative finance. He's like one of the leading guys about creative finance. If you want, he said he would send you his books for free. If you scan that QR code, you fill out a form, he'll mail you the physical books. This guy is awesome. So if you want to learn how to finance your deals outside of traditional lenders and mortgages, make sure that you come to our next meeting. And let's see. Oh, did I miss? Okay, last one is I'm trying to get a little bit of help to make these meetings better. So thank you to Caroline Cho, who is our secretary. She took notes this whole time. We will send those out. Stacy is very generously volunteered to help with sponsorship coordination. I'm also looking for a logistics coordinator. If you are very organized and want to help me, come talk to me. Love to have you on our team. And that's it. So now you guys can network, leave. Make sure you can take as much, if you have kids or anything, you want to take some of the food, that would be great. My kids are tiny and they will not eat. They will not eat the food. Yes, I'll go back to the QR code.
Yeah. I'll keep you in the know for sure. I appreciate it. A lot of these.
I started getting like face. I was like, I don't understand.